다음 연사는 골드만삭스의 하치우스 수석 이코노미스트입니다. 제가 월가를 취재를 하면서 본 경제 예측하는 이코노미스트 중에 가장 거의 정확하게 계속 맞추지 않았나 싶습니다. 우선 작년에 계속해서 연착륙을 주장을 해왔습니다. 그리고 맞췄죠. 지금까지도 그리고 연착륙을 지금 주장을 하고 있습니다. 스피치 타이틀은 글로벌 경제 전망, 탄탄한 성장, 낮은 인플레이션입니다.
And the theme that you're going to hear repeatedly is generally an optimistic view on our ability, the global economy's ability, to grow at a good pace while still bringing down inflation and seeing interest rates come down over time. We have an above consensus view for a majority of the major economies in the world, 2.7% growth this year and next year. I would say especially in the United States, we're at 2.8% for this year, 2.2% for next year, both of those numbers somewhat above the consensus. Now, why is that? There are two big drivers of demand and therefore GDP growth that we think are still going to be supportive in 2024, 2025. Number one, solid growth in real disposable household income, which is wage income, interest income, rental income, all in real terms. Last year was an exceptional year for real disposable income at 4% growth. This year we don't expect quite as much growth, but still in the 2.5% range, which is still a solid pace. And the big driver of it is the fact that real hourly wages are now again growing. Real hourly wages were falling in 2021-22 because you had a big increase in inflation. But with inflation having come down from 9% in 2022 to 3% now, real wages are now growing, and we expect that to continue. Second driver of the positive outlook for the demand side of the economy is that financial conditions were a big headwind to growth while the Fed was hiking the funds rate by 75 basis points a meeting for 4 meetings in a row. But financial conditions are now at least a small tailwind to growth by our estimates. The left-hand chart here shows our financial conditions index, which is a weighted average of short-term interest rates, long-term interest rates, equity prices, credit spreads, and the US dollar, with weights that mirror the impact of shocks to each of these variables on GDP growth over the next year. And we can turn that index into an impulse to growth from current and past changes in financial conditions, right-hand chart. And this shows that financial conditions were subtracting about 2 percentage points from growth in late 2022, but are now adding modestly to growth. So all of that is supportive. Now, you might ask if there is a significant amount of support, if you have an above consensus GDP growth forecast, how can that be consistent with inflation coming down, the economy moving back to balance? Doesn't this mean that there's a risk of overheating? The answer is that demand is strong, but supply is growing arguably even more strongly. And the impact on inflation doesn't depend on GDP growth. The impact on inflation depends on the balance between GDP and potential GDP, or between demand and supply. Supply is growing at a solid pace. Productivity is growing at a solid pace. We've seen a little more than 1.5% productivity growth post-pandemic, which is a bit above the pace that we saw prior to the pandemic. And maybe more importantly, we've seen a big increase in labor supply. Labor force participation has normalized. A lot of people had dropped out of the workforce during COVID. They've basically come back into the workforce. And we've seen a large number of immigrants in the United States that are coming into the workforce. All of that is boosting overall supply. Now, how can I tell that demand is growing more slowly than supply, or supply is growing more quickly than demand? The best way to see it is to look at the labor market and to look at changes in the utilization of labor. The simplest thing to look at would be the unemployment rate. It's at 3.9%. We'll get an update on this on Friday, but 3.9% is about a half percentage point up from the 3.4% that we saw in the spring of 2023. But there are also other indicators of labor market balance, supply-demand balance in the labor market. I've listed a few here. I'm calculating a standardized version of all of these different indicators of labor market balance, and then I look at the average, and what I find is that the labor market, based on these different indicators, has gone from badly overheated in 2021 to still strong, but similar to where we were in 2019 when inflation was at 2% or slightly below 2%. We can also see a similar message if we look at what's happening with wages. If the labor market's in balance, then you would expect wage growth to come back down to more sustainable levels than what we saw a year ago or 2 years ago, and that's indeed what we have seen, a drop in wage growth from the 5.5% range, which is well above a long-term sustainable rate with 2% inflation, to the sort of 4% rate, which is probably still a little above the sustainable level, but no longer by all that much. And leading indicators of wage growth are pointing to additional deceleration. So to me, this says there's likely to be a ongoing trend, or maybe a resuming trend of disinflation. We have seen higher than expected inflation numbers for much of 2024. The first quarter was definitely higher than we expected. But if I look at the balance in the labor market in particular, it tells me that the return to 2% inflation is paused, but it's still my expectation that we'll get back to 2% inflation in 2025.